Can you hear me, John?
All right. Good afternoon, everybody. My name is Jon Meyer, and on this call, co-presenting with me is Chad Halbur. Today, we are going to be talking about Estate Planning 101. Today is a more basic day, and then in June, we will be doing an Estate Planning 201, where we were going to get into more complex planning, but we wanted to kind of lay a foundation. So today's the foundation, and then we'll do a second version in June. With that, just a little bit of pre-work here. I do have a question box open on my screen. So if anyone has questions along the way as we go, please drop questions in. There is a Q&A box on your bar that you can use for that. If there's any questions after the fact, as usual, you'll get an email and you're free to respond and ask us any questions. We are recording this session. You will get a copy of the recording as well, so you can go back and see if there's something you like or if you need to share this with anyone. With that, I'd like to get started. As a review, everything we talk about today is not specific to a situation, so please don't use this for anything too specific. We always encourage you to sit down with your advisor and your estate attorney to have these conversations. We rarely, or if never really, have recommended people do anything with the online tools to write wills and trusts and stuff, because typically we find those things to be so generic that they actually cause more problems in the long run. So just a heads up. As your co-presenters, I want to point out that we come to you from a couple of different angles. I am heading up the wealth management team, and Chad is heading up the trust company team. So we actually approach this topic today and next month from a couple of unique angles. I get to work with people, especially the first generation, and helping devise plans and as we move forward, think through how you want to handle certain things with the next generation. Chad actually gets to see what happens with those plans, because he gets to see the next generation and sometimes the third and fourth generation and how those plans actually come out. So he has a really unique opinion maybe sometimes on what's working and what's not when these things get drafted on the front end. As usual, just one slide to remind you that BGM as a whole is a full service financial solution for people. Again, I head up the wealth management side, Chad heads up the trust side, but there are other parts to our services if you have any kind of questions along any of these lines. So please let us know. With that, I'm going to hand it off to Chad here. Today's agenda is pretty simple. We're going to talk a little bit about the politics of taxes and estate tax and what's happened over the years, getting into some of the current estate tax law. We'll then actually start talking a little bit about how to plan ahead, what the tools of the trade are, and we'll kind of finish up with this to-do list of ideas to think through. So as we get going, Chad's going to take the first sections. Chad, I hand it off to you.
Perfect. Thanks, John. To start with, I just want to give a high-level overview of all of the tax legislation that has happened over the last 10, 15 years. There's really been a lot of drastic changes. And as you talk to CPAs or planners in any way, even attorneys, there's a lot of changes that we've seen. Our goal is not to get into the specifics of each tax act and how they impact specific things, but primarily to point out that there's been a lot of change. And change fatigue in the industry, change fatigue from a client standpoint, and understanding that a lot of this stuff continues to evolve and continues to change over time. So we'll get into this a little bit on the to-dos, but an estate plan of 10 years ago is no longer maybe an optimal estate plan for today. And some of the planning that you've done at the beneficiary level or other levels may no longer be optimal. So we'll get into some of the specifics in that later. But just to give you a high-level overview, there's been a variety of different tax legislation that has come out that has really created both opportunity and challenges for clients. And in that, keeping abreast of that, keeping in the know on how to, which levers to pull to get the optimal outcome is really relevant. So it's important that you stay current on that, that we continue to advise and educate on that. And as things change, you make changes within your plan.
I think Chad and I agreed in the front end, we'd jump in on each other if we had points to make. He's going to talk about specifically the this one in the next slide, but I wanted to jump on this one. The Secure Act in 2019 basically changed how we inherit IRAs. Because if you remember, we used to be able to allow kids and grandkids to inherit IRAs and stretch them out for their entire life expectancy. That's no longer the case. Now you have to basically have them paid out over a 10-year period. So it increases the tax implication if you got to force the money out faster. That's probably one of the bigger things that have occurred in the last few years in these tax laws, because it completely changed how we do estate planning. I just want to point that out. Chad's going to talk about that one because that's another big one.
Yeah, as it relates to the the Act of 2017, there's a lot of the stuff I'm going to talk about right here that came into play with that. So they increased the gift and estate exemption amount at the federal level. So I'm going to give a high-level background, and then we're going to get into some of the specifics as we move forward. But the current federal estate and gift tax limits are $13.6 million. So if you're married, that means you and your spouse have a $27 million exemption. Within the federal and estate gift tax component, that takes into account a variety of things. You can gift over your lifetime and not have to pay estate tax or gift tax if you do not exceed that 13.6 million. So as we work with clients, sometimes there's opportunities for them to gift. The exemption amount right now is $18,000 per individual. So you can give $18,000 to any individual without having to file a gift tax return. Once you exceed that, then you have to file a gift tax return. And then any gifts above that level per individual go against your $13.6 million exemption. So for a lot of clients, this is confusing because we've got a federal level, we've got a state level, if you're in most states, Minnesota being one of those states. And trying to understand all of the moving parts can definitely be challenging. So what we're looking at is how do we leverage that in a way that if you fall into a group where your estate exceeds $27 million, how do we provide you some tax strategies and opportunities to not have to pay a federal estate tax? So those are strategies that we'll get into in more detail really in the 201 planning of next month, but just to give you a baseline for what those levels are. It also gives you a baseline if the federal exemption is material to you or not. So for some of our clients, they don't have 13 million individually or 27 million individually. So we're focusing more on how the state estate tax impacts them. So just a variety of different examples here. Within the federal laws, though, there is portability. So what that means is one of the spouses can pass, and if they don't use their full 13.6 million, as long as they do file an estate tax return, that can be, the portability can be brought over to the surviving spouse. So you don't have to use the full $13.6 million at the first death. to be able to utilize the full 27 million if you die within this range or time period. So that's an important part, but the big catch is, as we say all of the time, the devil is in the details. And if you don't understand that that estate tax return needed to be filed because you assume the spouse didn't have enough money that it mattered, that's where you're going to get caught and you lose that opportunity going forward. If you were to pass away with estate assets in excess of the federal level, the estate gift and GST tax is, the top rate is 40%. So in essence, you're going to lose 40 cents on the dollar for every dollar that exceeds the exemption amount. And then the other important part is this level has been increased temporarily. So the 13.6 million is set to sunset back to about 7 million, or the 2017 levels, at the end of 2025. So for clients who have net worth in excess of 13 million individually, or 27 million as a husband and wife, you really need to be making a conscious decision if this is something you want to take advantage of by the end of 2025 or not. So we're going to get into specifics on that in the next section in series 2 next month. So make sure that if you fall in that camp, please attend. There's going to be a lot of good material and ideas and strategies that we can talk about at a general level. But as Jon said before, every case is unique. So if you do feel that some of these apply, please reach out to us and make sure that you heard it correctly or understood it correctly, so that we can advise you in an appropriate way. Next slide, please. Now, a lot of people make these decisions based upon tax reasons, but there's also non-tax reasons too. So what we're going to talk a little bit about is the two different components of this. I work with clients, as Jon had said, I work with clients, and what we see is the after effect of planning. So clients come in, they do their planning, they eventually pass away, and we get the opportunity to work with their heirs. And sometimes that planning works perfectly, and sometimes the planning didn't work the way they wanted it to. So there's a lot of non-tax reasons that come into play. And if we're only focusing on the tax component of this, we're really missing out on a big opportunity to think about how legacy and how human interaction and human decision-making comes into play with generation 2 and generation 3. So we'll talk a little bit about that too. So even with portability, we're still talking about how trust can make sense. The tax reasons, it eliminates the estate tax on appreciation of assets for the spouse. It's a good way to look at using these limits to benefit all of our clients, and then decoupling states too. So there's different rules and different levels for the different state versus federal. So we want to make sure that we're aware of that. Jon, are there specifics here that you wanted to hit on that, the tax side of it?
Oh, we'll talk about Minnesota on the next slide. So,
okay. Non-tax reasons. Limit direction of deceased spouse's assets. So there's planning that we can do that we can help ensure that these assets go and get used in a way that's specific to what the grantor or the deceased spouse wanted them to be used for. It can also be limiting the use of principal. So we can set it up so there's only access to income. Creditor protection, professional management, all of those things come into play to make sure that the asset management, the longevity of these assets, the use of these assets tie to the goals, values, and objectives of the grantor or the deceased party. So I'll talk about Minnesota. Go ahead.
Well, I was going to say, I was going to jump in there. I think what I see a lot is when I'm sitting with clients who don't reach the maximum limits of 13 million each, they basically will say, I want to keep things simple. I don't even know if I need a trust. And I think the word simple gets confused a lot, because I think the simpler answer is actually to use a trust. In general, what we see is that you may not have a tax problem, but you do maybe have a control problem, particularly when we look at the next generation, where we do worry more about divorces, um, abuse issues with alcohol and drugs, bankruptcies, creditor issues, all these things come into play. Trust can help protect the next generation a lot. It used to be more of the path where we would say, well, either give them the money outright or wait till they're a certain age. You know, when they hit 35 or 40, we start giving them the money. More and more, we're seeing attorneys suggest that you put a trust in place at most dollar amounts, and just let it run in place forever, because it protects the assets from the child's, problems in life. They can still have access, but I just bring that up because we don't always see necessarily the tax answer all the time, but the non-tax answer comes up in every single discussion.
Yeah, I can add to that too. As we're working with clients, there's some reasons, as Jon spoke to, that we really want to protect the beneficiaries from themselves, either because they're spendthrift or they've got some issues with. I've seen it where spouses are the issue. It's not the child, it's the spouse that's the issue. And this allows that spouse to have some protection so that they don't get to control the assets. They don't get to make the decisions. And whenever you're dealing with inheritance, it's really two people. It's not just your child that we're worried about. It's your child and your spouse that we're worried about, because the influence that the spouse can have can be pretty damaging in some cases that we've seen as well. So the goal really is to make sure that these are set up in a way that's constructive. I also feel like the stigma of a trust has changed a little bit. At least when we're working with clients, it has. The stigma of my parents don't trust me and they put it in trust is different these days. I think a lot of what we're seeing is my parents were intentional. They know that there's tax benefits here. My parents knew that there was some asset protection benefits here. This can really be an account that can help my family and my children's family, and can go on in essence in perpetuity or for a couple of generations, however you want to look at it, and can continue to add value and help us live more successful lives, more meaningful lives. And it has been really, really powerful for a lot of cases when set up correctly and when communicated correctly. All right, so we talked about the federal level. Let's talk about the state level. We're going to focus on Minnesota because a lot of our clients are Minnesota residents. But Minnesota has a $3 million estate level. And if you have assets in excess of that, there's a max of 16% tax on that. There is no portability. So bringing those three things together, what we're looking at is, when we're looking at planning for husband and wife, we want to make sure that each spouse has somewhat of an equal balance in their assets and how their assets are owned so that they can get the maximum benefit. If we have a client that has $6 million in total assets and they have it all in the husband's name, for example, what happens is they can only use that $3 million exemption, and they're going to have to pay estate tax on the other three. Whereas if they split it so that each spouse has $3 million, they can fully utilize the exemption amount and they wouldn't pay any estate income tax. When we use examples, these are always simplistic examples. None of these numbers tie out to the penny. None of these are exact, but just to represent the case, it really is important that you split the assets out to try and maximize the use of that $3 million exemption. The other thing that I think is interesting is Minnesota does not have a gift, a tax on assets gifted during life. So with the federal level, it looks at gifts made during life and at death. And with Minnesota, what it's looking at is just gifts made after death. So you do have the ability to gift assets while you're alive in Minnesota and not have it go against your $3 million. The caveat, of course, is that there is a 3-year look back. So if you were to gift assets in excess of the annual exclusion amount, which is $18,000, then that would get picked up on a tax return as you file that. They would look back and see that you would have gifted assets within the past 3 years, and then those would now become includable in your taxable estate. So as long as there's that 3-year gap between when you gift, then Minnesota is really only looking at your gifting at death. So one of the things that we look at is how do we leverage this and make sure that we're providing the best advice for our clients and helping them work through that. So there's a variety of different ways we can do that, and it really is a case-by-case scenario. The other thing that is relevant to Minnesota is there are a lot of our clients that don't use Minnesota as the situs or jurisdiction of their trust. And Minnesota has a lot of rules, and Minnesota is a very aggressive tax state. So they're always looking at finding ways to bring in revenue to the state. And there was a case, the Fielding case, that basically gave us some flexibility. With flexibility, there was also some clarity as well. Minnesota still looks at trusts set up by Minnesota residents or having Minnesota assets in them as statutory resident trust, which means Minnesota is going to want to tax the earnings and income on those trusts. But there are a couple ways to look at this and to work around it. The Fielding case gave us some clarity on that. The first thing we have to look at is what's the minimum connection test? Does the trust or the assets meet the minimum connection test? And if they do not, then we can say from a due process, it's not deemed a resident trust. There's a couple of loopholes we have to go through. There's some additional tax reporting that has to be done year over year, but there are some options. So there's a little more clarity than there was in the past, but it's also adding to complexity and confusion for clients. So in areas like this is where having a competent tax professional and estate planning professional can really add a lot of value. So just having a trust that is not sitused in Minnesota alone is not enough to avoid Minnesota income tax. You really have to understand some of the other components and the different levels that they look at to understand
that. All right. I'm going to take the next set of slides and talk about a little bit more about some of the general documents and stuff you have to have. But I want to start with the Clark case because the Clark case basically upended some of what we do. In 2014, Clark versus Ramaker, I won't get into the details of the case. Basically, what it said was that when someone inherits an IRA, they are not considered retirement funds. And that's a big deal because retirement funds generally are protected from bankruptcy and creditors. But if an inherited IRA is not considered a retirement fund, it now allows that to be invaded in cases of bankruptcy, for example, by the courts. And so this changed everything because it used to be easy to just tell a client on an IRA, yes, go ahead and name your child or your grandchild as a beneficiary. Today, that's not that easy. So what we've probably shifted more to, quite honestly, is if you're sitting on an IRA or 401k or 403b asset that is, less than $1 million, it becomes a question of, do we want to worry about setting up a special trust language to handle this? That's a case-by-case issue because sometimes it doesn't make sense. Sometimes it might make sense. It depends on the family. But oftentimes, if we're dealing with million-plus IRA or 401k accounts, it becomes more of a real reason to set up a trust that handles the IRA. So in essence, the trust gets named as the beneficiary, and therefore it controls the flow of assets out of the IRA and into the hands of the people that are getting them. That's what protects those assets more from bankruptcy. So I bring it up because, I remember back in 2014 when we scrambled like crazy to help clients rewrite things with their attorneys. But to this day, we still have this case hanging out there that basically says we should do it different. So Mike, there's no magic to what I'm saying here. My cutoff is to say, if you've got more than $1 million in an IRA, 401k, 403b scenario, any kind of retirement account like that, you probably should at least talk to your attorney about whether it makes sense to have those assets directed differently than having a direct beneficiary. That does come into play in our overall planning more. But let's jump into some of the basic documents that everyone should have. So from a very basic perspective, everyone needs a will. Now, this gets into a little bit of a different issue when you have a trust, because the whole point to having a revocable trust is to avoid probate, to not need a will. So what we do in those scenarios when you have a trust is we actually use a pour over will. And a pour over will is going to be more simplistic, because what a will is a will gives directions to the court. If you think about it, we often talk about whether or not you want to go through probate or not. A will still has you go through probate. It's just that it tells the court exactly what to do. So it should speed up probate, hopefully make things simpler. A pour over will is used when we have a trust scenario where we're setting up trusts to hold all the assets and whatever. And in essence, what we're doing there is we're just simply having a couple page document that says, if I forgot to put something in the trust, put it in the trust. So the pour over will also still has those assets going through probate, but they're going to be, it's a very simple instruction to the court as to what to do. And where we see this a lot, quite honestly, just simplistically, is like people forget to, or not even forget, they don't want to put their cars in the name of a trust, or they feel like a piece of property they don't want to put in the name of a trust for whatever reason. So the pour over will helps capture those assets and dump them in. The second big thing that you're going to want is the healthcare directive. Now, let me define the difference between the healthcare directive and the power of attorney. The healthcare directive is there to give instruction when something medically is going on. The power of attorney is there to allow someone to act on your behalf when something financially is going on. So I bring that up because the healthcare directive and the power of attorney are different. The power of attorney, once you sign the document, it's live. So you may sign it thinking, well, if I ever have a problem, then my brother will take over. No, your brother has the authority that second. So what we will tell people is power of attorneys are great, but if you don't want someone to potentially exercise it right away, you better not hand that document over to them. But maybe you give it to them like when you are going into surgery or something, so that there is that. But make sure they know where it is still, because at the end of the day, if there's something that's goes wrong suddenly, they may need it. The power of attorney is used for financial issues, where you would have them, pay your mortgage for you, or make sure distributions are made so the spouse can continue spending, whatever. The healthcare directive is more unique to what are the health issues. So if you go in, you're in a coma, and then all of a sudden while you're in a coma, they find that, hey, everyone thinks of this as just pulling the plug. It's not just pulling the plug. You're in a coma and you suddenly find out that you have cancer. Someone's got to make the decision, do we give them chemo or not while you're in a coma? I mean, those kinds of things can come up. What I will tell you is oftentimes we will have two separate people be in charge of the healthcare directive versus the power of attorney. I say that because not just moral hazard of somebody wanting the money, but oftentimes it's simply brain power. Like if you're a super, super emotional person, like you never want to see mom die, you probably should not be in charge of the healthcare directive. Same thing with power of attorney, though. If there's someone in the family that's just not good with money, they probably shouldn't be the power of attorney. And I think that's where we see a lot of concerns, is that clients typically are going to say, well, I want to be equal because I don't want to upset my kids, or I want to make sure they all operate together. That's probably not the right way to think about it. You probably should make decisions based on who's got the strength to do these things. I'm going to throw in a pro tip here. If you have a child or a grandchild who turns 18, go spend $1,000 with an attorney and get the healthcare directive and the power of attorney in place. Have the 18-year-old sign all that. More often than not, they're going to name mom and dad as their person. But it's important because we've seen, and I can tell you, I have personally experienced with my children scenarios where they go into an ER and the doctors won't talk to you, or they have something going on at school or something where you need access to something and you don't have power of attorney, so you don't get any information. It's very important as soon as they turn 18 that these documents get put in place, because things do come up. And that is kind of the pro tip of the day if I can get you to do anything. Now, the next thing to consider with what we would typically call basic estate planning, is whether or not you want to have some sort of revocable trust. Sometimes they're called bypass trusts, AB trusts, you name it. What a revocable trust does is it basically acts as you. So it's going to use, while you're living, your social security number. So you don't have to file a separate tax return or anything. It's going to basically be you. So you would retitle all your assets into the name of the trust. It acts on your behalf, basically for all kinds of stuff. One of the reasons people oftentimes don't retitle, for example, cars in this, is because it's a bit of a pain to provide trust documents to your car dealer when you want to sell or buy something. So, there's some logic here we'll use, I guess. But basically what these trusts can do is the revocable trusts allow you to skip probate because they're specific, which means that whoever the heirs are going to probably get the money faster. Like sometimes within 2 months, we have this stuff running. Whereas if you go through probate, it could be 9 months or more. So that's one big aspect. But the second piece is we use these things because then not just avoiding probate and stuff, but at death, we basically can then lock in the assets and use up your exemption if possible, which is that 13.6 million today. But then let's say spouse 1 dies and spouse 2 is still living and still lives for the next 10 years, 20 years, whatever. Any appreciation left in that trust that from the death of that spouse that keeps on going because it becomes irrevocable at death, that appreciation is outside of the estate of the current living spouse. And so you can pass on more value to the family that way as you keep moving forward. There's also, of course, asset protection, which we talk about ad nauseum because we want asset protection from all the little things that come up in life. And Chad already talked about the decoupled state tax, so I'm not going to spend much time on that. But just know that this is kind of a basic level. So when we talk about basic documents, it's always wills, healthcare directives, powers of attorneys, and most likely a revocable trust. That's kind of basic level. When you then jump into the next step, and what I'm not going to do is go into detail today on these. We are going to spend our next session in June on these kinds of topics and get into more detail about what they are, how they're used, because this is where you get into some of the really cool planning if you need to use this stuff. So I am not going to bring this all up today. I just wanted you to be aware of the types of things that get into the more advanced side that we'll spend time on next time. With that, we're down to our last 2 slides. Chad and I are going to kind of bounce off each other on these last 2 slides because we each have probably unique opinions. So I bring that up because if you do have questions, right now I see no questions in the Q&A, but if you do have questions, now's a good time to throw them out there. So let's get started on our to-do list. And I'll start with number 1, Chad. Gift income generating assets. So oftentimes when people want to gift assets, we talk about gifting assets that have, especially to their children or something, that have large capital gains, because you might be able to give away some of your tax problem, let your kids pay the tax, or maybe they're paying no tax. But what sometimes gets missed is if you can do that, but on top of it, give away assets that are income generating, it actually helps your tax return today. So I'm not looking at this from the perspective necessarily of giving your child the income as a big deal, because it may or may not be a big deal, but managing your current tax return, this could actually be a bigger deal. Where this can come into place sometimes, depending on what clients are doing, it could be income generating stocks or something, but it could be a piece of real estate or something else that's generating income for you. So just think about it from that angle as you think about, do I want to give money away to my kids, my grandkids, and quite honestly, even to charity? Because it could, there could be a dual purpose here.
I'm going to add to that before you move on. I think the important part is understanding what the goals and objectives are and your time frame. So Jon mentioned gifting low basis stock. I have another scenario where gifting high basis stock and retaining low basis stock could make sense too. So if you die with low basis stock, you get a step up in basis. And what happens is, let's say you bought 3M 20 years ago, and your basis on 3M stock is $10,000, and it's currently worth $1 million. When you pass away, if you own those assets directly, you can get a step up in basis on those. Whereas if you gift them, so let me finish that thought. You get a step up in basis, meaning when you die, your basis is no longer $10,000. Your basis is $1 million, and your current market value is $1 million. So whoever gets those assets does not have to pay tax on those assets. So there's a strategy there. The other strategy is what Jon talked about, is gift low basis stock. You may have kids who want to use these funds now, and they are in a tax bracket where they wouldn't have to pay tax. So again, the scenario that we're dealing with has a big impact on the recommendation we give. So to Jon's earlier point, depending upon what your scenario is, we're going to have a different suggestion or a recommendation based upon the mix of your assets, the mix of tax brackets for you and your family, and a variety of other things. So definitely kind of keep thinking about asking for direction, and none of these suggestions apply to everyone. It really is facts and circumstances based.
Yep. Number 2, maximize lifetime gift tax exemption. Where this comes into play, I think, is in the point Chad was making earlier about gifting while living as opposed to waiting until death. Making gifts to an irrevocable trust, let's say, for the benefit of the spouse and children. That makes sense. We'll get into that more in our next session. But what we're really trying to do is lock in that exemption amount today, because if at the end of 2025 things change, then all of a sudden you may have a lower exemption amount that you get to use going forward. But if you did it today, you get to use this old exemption amount. This could be a big deal. And everyone says, well, I don't have 13.6 million. It may not matter. You might want to look forward and say, if 7 million is the new number, do I have more than 7 million? So there are things to consider in this. You also have to consider where you're at in life. You might only have $4 million today, but you're 50 years old. And if you think about it over your lifetime, what happens if it keeps growing at certain rate, so just keep that in mind as you're thinking about this topic. Third one, utilize tactical gifting at 40%. One of the things we see that people don't always appreciate, and there's really a couple scenarios here, is when they actually should pay tax. And in doing so, it may make sense when you have certain types of assets. If you have, for example, assets where they're low value today, whether it be because the market just crashed 25%, whether it be because you have a business asset that is going to jump in value fast, whatever it is, there are reasons where you might actually want to go above the 13.6 million each and pay some of that tax because you think the springing value is there. And in that scenario, it might make sense to do that and just pay the tax yourself. That's something that most people don't think about, but that's where, when you hear about some of the big opportunities in life, like you've heard about with some of the politicians that have these giant Roth IRAs, that's what they've done, is they've found things that have really low value that spring fast. So there could be reasons to do this, particularly if you're giving those assets to family members. I don't know if you have anything to add to that, Chad, but.
Nope, not to that one.
Okay. Fourth one, Chad, why don't you take that one? Loan assets at AFR.
So there's a couple different scenarios. The scenario I have seen this used at is in the trust world. So that's the example I'm going to give, John. So we have clients where instead of making distributions out of a trust, we can loan assets at an applicable federal rate to beneficiaries. And in doing that, what it does is it allows those beneficiaries to borrow at a cheaper rate than what the market would bear. We still have to do it at an applicable federal rate to make sure the government deems it as a loan versus a gift, because if it falls below the AFR rate, it's deemed a gift. So there's a couple different strategies we can do to help our clients and beneficiaries preserve value in the trust, but allow them some financial flexibility to improve their overall financial situation. So scenarios apply where it's down payment on a house, or it's the purchase of a house, and instead of borrowing at higher rates, we can allow them to borrow at lower rates. So there's a couple strategies there that we have used that have been very successful for clients. It's also knowing which clients you're using this for, because there's also some clients that aren't going to pay it back. So you really have to understand. Again, this is why the recommendations are specific to the case at hand and understanding the beneficiaries and some of those things. So please check in with us on some of these strategies.
You bring up a good point though, Chad. There are clients that we've worked with where they know that the loan probably doesn't get paid back. And so then what you have to do is you actually have to, on the back end, do an addendum to the estate plan, potentially, to say that that asset, if forgiven at death, counts towards that child or that grandchild's share of the estate. Otherwise, you could run into a big fight that one kid got more than the others. So just keep in mind, if you're going to go down that route, that there are ways to maybe deal with it, but deal with it on the front end so that there isn't fighting on the back end. The second point I'd make, because Chad mentioned it, AFR stands for applicable federal rates. And if you want to, you can Google current AFR rates, and you'll get the IRS document showing that, because they change every month. Typically, the way they work is there's 3 terms, kind of a 0 to 3 year, a 3 to 9 year, and a 9-year plus. You think about loaning your kids money to buy a house, probably use the 9-year plus rate, which currently is around 4.8%. But if you think of them going out and buying a mortgage, they probably pay 7.5%. So, you know, in today's world, AFR rates can be way cheaper if you want to give your children a leg up, and do it in a way that's completely acceptable.
The other way I see it is, if we're gifting from a trust that they are the beneficiary of, they're basically paying themselves back, right? So they're not paying interest to a third party. They're paying interest back into an account that they are the recipient and beneficiary of at a later date. So there's just some strategies there that make sense.
Yep.
John, I see we do have a question. Might be a good time to hit that. Do you want me to?
I was going to hit that at the end if
okay.
We want to just keep going through this.
All right. 529 funding, I can jump on that. So that is, there's 2 things here I want to talk about. First of all, it's a great tool to be able to fund assets for grandchildren, and in some cases, even your own children. We have clients who will start saving into 529 plans when their children are born, and save $1,000 a year, $100 a month, whatever the answer is, and up. And over time, it really can accumulate. The other way we see this is grandparents. Grandparents are always looking for opportunities to help when we're talking to them, and understanding how challenging it can be for parents to do that. This is a way for the grandparents to gift as well. So it's another strategy that can make sense. Did you want to add to that? Otherwise, I'm going to go a little bit of a different direction.
Yeah, let me add to that there are new rules that are out on 529, so that if you overfund, whatever overfund means to you, and there's a bunch of qualifications to this, so don't take everything I say like, oh, I'm going to go do that, because there are a bunch of little details. But the new rule says that you can allow the beneficiary, assuming they qualify to do a Roth anyways, convert up to $35,000 of a 529 to a Roth. And then they have that as after-tax money the rest of their life. Now, the caveats are the 529 has to be open at least 15 years. The money you're converting has had to have been in there at least the previous 5 years. They have to have be able to qualify to do a Roth anyways. And you can't move the 35,000 as a lump. You move it in the annual increments. So 6,500 a year, let's say. So it's going to take you, 5 years to fund this. There's a bunch of those kinds of rules you got to understand, but just know that's out there because that's a new rule on 529s.
It's a great benefit. And for anybody who didn't understand what he meant by overfund, so let's say you put $150,000 or the 529 grows to $150,000 and the beneficiary only spends 100 or 120. So it's overfunded, meaning they don't intend to use it. So that's where that can come into play, right, John? You can just elaborate on that.
Yep. And quite honestly, Chad, the conversation I had recently with someone is, well, why don't I just stop pulling out when I hit that level and let my kid take 35,000 more into a Roth, get them started for retirement, and then I'll just pay the rest out of my, cash account. Fine. Like the rule's flexible.
Yep. So it's a great point. And those are the strategies we get to see because we have the flexibility of working with a lot of clients. So it's kind of fun. The other thing on the gifting side, I think it's important. And if I misspeak here, Josh or John, correct me, but if you give directly to pay tuition for someone and or pay for medical expenses, that is not a gift. So as long as you're paying to the institution, that does not go against your gifting level. So for some of our clients where they want to have a higher level of gifting available, maybe they want to do the 18,000 to the kid, and then they also want to help them with school on top of that. There is the ability to make those payments directly to the educational institution or the medical institution directly and have it not be deemed a gift. So another way to accelerate and assist with some financial support without having to hit some of those other limits.
Yep. All right. The last two I'll just handle together a little bit. Charitable trusts we'll get into more in the next section. In June, we don't see them used as much as we used to. What we see used more often is the donor advised fund. From a gifting perspective, a donor advised fund is interesting because all it is a brokerage account that is owned by charity. So you could have any charity, including the big firms of the world like Schwab, Fidelity, Vanguard. They all have a charitable arm that has a donor advised fund. But what you do is when you put the money into that account, you get a tax deduction that year, but you don't have to hand it out that year. You can hand it out over whatever period of time you want. So one of the cool things that we'll oftentimes do is try to marry donor advised fund gifting with other tax issues on your tax return. And in doing that, we can sometimes reduce your taxes a bit. One of my favorite strategies, quite honestly, is just saying, let's look at the on average how much you give in a year to charity, and let's multiply that by 5 and put 5 years worth of gifting all in this year, and then we can use that to offset another problem. So however you want to think about it, donor advised funds are really flexible and quite honestly kind of fun to use because they're super easy to gift out of to other charities. And what most people don't even realize is that under the new rules, you may not even be itemizing your deductions on your tax return. You might just be taking a standard deduction and you might not be getting a deduction for your charity. However, if you do my thought, which is times 5, you might actually be able to deduct that because now you might get above the limits for itemizing. So just keep that in mind. It's just a new way to think about how to do charity as opposed to giving directly to the charity. All right. We'll run through these a little quicker, except for the last one. So changing estate change in state residency is an issue that some people want to deal with, whether it be moving to Florida, like everyone wants to do, it seems, or back. We see it back. The thing that I will say is, as most people know, if you're not there for 6 months and a day, you won't qualify. So if you're going to do that, you better get going because we're nearing June. Second point, balancing estate values. Chad commented on this. Too often when we're talking about state estate tax with the $3 million threshold, people get in trouble because one spouse might have $4.5 million on their side of the fence and the other one might only have $1.5 million on their side of the fence. You do have to balance those out, or you could get yourselves in trouble and pay some tax. So I think that's a big, easy one. Third one, scheduling a meeting with your attorney. That's easy. If you, by the way, if anyone on this call needs a referral to an attorney, we work with a fantastic firm that just focuses on estate planning. Happy to give you a referral. And then fourth, implementing. And I think Chad and I both are going to agree on this topic. Implementing is 90% of the problem. Most people will go to their attorney. Most people will get the documents written correctly. But what they don't do is they don't follow up and implement it. And by implementing, we mean retitling the assets, confirming the change in beneficiaries that you need to do, electronically storing documents, communicating with your future personal representative or trustee about where the documents are stored and what assets you have, where the passwords are, all these things. People don't implement. We try to implement for our clients on a very proactive basis, but I'll tell you that most of the time when new clients are coming in the door, it is not implemented. And so if you have the coolest documents on earth that aren't implemented, you're going to have a big mess when someone passes away. We see it all the time. And it's what I would tell people is you're going to spend not even twice as much, but potentially 3, 4, 5 times as much fixing it after death. It's a very expensive process. I don't know if you have anything to add to Chad, but you and I agree on this topic.
I agree completely, and I've seen it go completely against what the client intended because they didn't follow through. And once they pass and the documents are in place and they didn't retitle their home into the trust, or they didn't do what they wanted to do, it can't be changed really. It's tough. The other thing I kind of put notes in as we were talking is our goal when we work with clients is to create as much simplicity as possible and only add complexity when complexity is required. So where we can keep this as simple as possible, we want to do that. We're not interested in adding all these different unique trust structures just for the sake of it looking good or being able to talk about it at a dinner party. Really, the simpler we make this, the easier it is for everybody. But the caveat, of course, is very few of us have simple makeups, whether it's relationship makeup, whether it's asset makeup, whether it's net worth. So I was meeting with a client Monday night and, very simple. Let's call it a $1.5, $2 million estate. But it's a second marriage and they don't share kids. And one spouse brought more into the marriage than the other. And one spouse already had their kids have an inheritance because both are widowed. That is not easy. That is complicated. And trying to ensure that they understand the path and the direction that assets will flow is really critical in scenarios like that. So the asset makeup, all traditional assets, other than real estate, very simple stuff. But the relationship complexity really makes it unique, and planning is necessary in cases like that. So again, some of us or some of the clients we work with don't think their estate is that complex until you really talk them through it and educate them on how it could go differently than what they think it will. So again, I would leave it at that.
I agree. All right, we have 5 minutes and we have 3 questions on the board. So if we'll answer 3, and if others come in the next few seconds. First question, how difficult is it to retitle assets into a revocable trust? And what types of assets would be top priority? I think from a basic level, it's how difficult is it is a question. It's administrative pain in the butt sometimes because you have to repaper all your brokerage accounts and your bank accounts and everything. You have to go back to the county to maybe move your real estate in. If you have corporate interests like an LLC or something, you might have to potentially do something there. So how difficult is it? It's, it's a relative answer. You either you do it, or if you don't do it and you die, you probably have more problems. So I would say it's something you just kind of got to do. The second part to that is what types of assets would be the top priority. Again, I don't know that there's a top priority. I think it goes in stages of ease where moving like brokerage accounts and maybe a bank account stuff into a trust is actually, fairly straightforward, and you sign some paper and 2 weeks later it's done. That's probably there. But I wouldn't call one more prioritized than others, because I think sometimes when we look at it, what we may think is, well, that might not be the top priority because it's a piece of real estate that I've owned forever and blah, blah, blah. That's the actual biggest pain in the butt asset to deal with at death sometimes. So I would argue that that kind of stuff should get done. So the answer to this question really is everything's kind of got to happen at once. And that's just part of it. The second question on the board was, do IRAs put into a trust still need to be withdrawn over 10 years? First part to this answer is yes. So if the IRA is going to be an inherited IRA by children and grandchildren, the 10-year rule applies no matter what. So that's not the issue. I do want to clarify one thing. The way the question's written, this is I may have said it wrong too, so I'm just going to clarify this. The IRA itself doesn't get put into a trust. The IRA basically has the beneficiary listed as a trust, so that when cash goes out of the IRA, it has to go through the trust. And then the trust looks at where does that cash go, and it sees on the back end, oh, it goes to this child, and then it disperses to that child. So the trust is acting as a gatekeeper. And I want to make that distinction because technically an IRA has to be owned by something living. It can't be a trust. So if you put it in a trust, you actually create a different problem, which triggers a 5-year rule, not a 10-year rule. I don't know if you have anything to add to that, Chad, but
Nope, you nailed it.
The third question is gifting appreciated stock to a donor advised fund paired with a Roth conversion a reasonable strategy to consider in creating a net zero tax effect? I have most of my retirement funds in an IRA. That is the perfect scenario where we oftentimes will try to create tax at especially lower tax brackets if possible. But we'll create tax and then pair it with a donor advised fund because they have charitable intent, and try to offset that tax as much as possible. Sometimes it creates some ancillary tax issues at the state level or something, but in general, we can kind of wash it out. And that's a really good way to use charity compared, and then use it against something like simple like a Roth conversion.
The other scenario I've seen, John, that we've worked with is clients who have a sale of a major asset or sale of a business, to use donor advised funds is also a nice pairing as well. We used to use it quite a bit with charitable trusts, but now the donor advised funds are just a really simple answer. So the complexity of a charitable remainder trust or charitable annuity trust is still viable, but it's client specific, and it's a different strategy, but both are effective.
Yeah. And I think to your point, Chad, one of the reasons donor advised funds get used more is you can get an account set up and funded within days. Whereas other charitable trusts, you got to get them drafted. It takes months sometimes. So
yeah, the one caveat that I do like with the charitable trust, though, is if you have a beneficiary that you want to have an income stream off of those assets, it's a great tool. You don't have that option with a donor advised fund. So again, what are the goals and objectives, and how do we match a solution with what you need is really what we think we do our best work at.
What a segue, Chad. We will talk more about that exact issue next in our next hot topic, which is June 26th, where we're going to dive into estate planning 201 questions. And we're going to get into a little more detail on some of the more complex things. So I hope all of you can join me, and Chad will be there as well. So with that, we're going to say goodbye, and we hope everyone has a fantastic rest of your day.
Thank you. Have a great day, everybody.
Thank you. Bye-bye.